Welcome everybody to another episode of Ask Me Anything. Go ahead and get those comments in the chat box. We're going to go ahead and go around the horn here in just a moment, but go ahead and get those comments, those questions, all the kind of stuff into the chat box. We'll see you in 14 seconds. All right, everybody. Welcome to another Ask Me Anything. As I said before, go ahead and get those questions into the chat box. We got a few announcements before we get going and go around the horn here. So for those of you that are not aware,
Ryan, what are we announcing?
Our 3-day events.
What?
We got our virtual events coming up. So Friday, Saturday, and Sunday, we've got our Blueprint event, live virtual 3-day event. It's going to be packed full of speakers, packed full of strategies, information, knowledge. I'm going to put the comment or the link to that in the chat box right there. If you have not already signed up, go ahead and grab that link. Sign up for that event. If you do the VIP level, you'll get access to all the recordings. So make sure you do sign up for the VIP one if you can. Then you can go back and watch all the videos if you miss any of that kind of stuff. But go ahead and grab that link, and we will definitely want to see you there. Every time we do these live events, they are very popular. We get a lot of comments, everybody gets a lot of value from them. So definitely check that out. So with that, I'm Brian Fouts up here in the great Pacific Northwest in North Idaho. It's actually finally snowed here a little bit today. We have not had a lot of snow this year. It just snowed a little bit and then stopped. So it was maybe a quarter of an inch. It was just kind of a tease, but maybe we'll see some more snow the rest of this week. But with that, I'll hand it over to Linus.
Hey everyone, Linus Nolt here from Hopkinsville, Kentucky. White land out here this week. We got several inches of ice and snow, and it's still stuck to the roads. The plows can't even break through it. It's pretty wild for here in Western Kentucky. But yeah, I'm staying warm. Happy to be here, help answer any questions and provide any context and ideas and things that I can. Definitely very passionate about the infinite banking concept, which is what we're here to talk about today or to answer questions about, but it is an Ask Me Anything. So definitely feel free to ask on anything you'd like. But we reserve
something you might not answer though. Something
we reserve the right to avoid certain topics if it's too bad. All right, don't today. But yeah, certainly happy to be here. Thinking about Tess right now. She is fairly sick this week. Can barely talk anymore after doing some talking today. So definitely keep her in mind. But yeah, she is in the chat though, so I think she's doing all right with the thumbs, right? But yeah. Anyways, Kevin, take it away.
Hey, what's up, guys? Kevin Krause, upstate New York, up here with Chris, Joe, and Shauna and the team. Thankful to be here. Looking forward to answering all your questions, getting you guys set up to solve your money problems. As far as weather goes, we got a big, huge winter dividend of snow of 2 feet. So we're definitely whoever's got to work inside dealing with the snow. I'm sorry about that, but it is what it is. But all our kids were outside having fun, sledding, making snowmen, etc., and having tons of fun out in the cold.
All right, take it away, Jason. Oh, there's a kid up there. I see a hand. It's a claw.
Yeah, that was my little guy. Sorry about that.
Yes, hello from the city beautiful, which has been refreshing the last couple of days. Connor went out and put his feet in the crisp morning frost and barefoot, and he was excited about that. And Patty was kind of teasing him like, "Hey, we go to Utah, we go skiing. You can do that anytime in Utah." I say, "But Mom, this is Florida. Our grass never freezes." So it was fun waking up, hearing him be excited about that. We're always excited to be here, answer your questions, everything infinite banking related. Please, we answer other questions as well, but let's keep it focused to how we can really serve you best with all things infinite banking and how you can have back control in all these crazy times and some guarantees. And over to the long lost Bree Shaw over here. Welcome back, Bree.
Thank you. Feels like it's been a hot minute. I'm in Alaska for anyone that doesn't know and might be new to joining us and watching the show. I'm here in being in Alaska. We set a new snowfall record for January, but
high or low?
Yeah, just business as usual with the weather conditions. I'm indoors, so all I have left is talking on the phone, and I've missed the last few sessions helping clients. But I'm, partners with Joe, HELOC Joe, and I've had my IBC policy going on 4 years. I've been using the concept to the maximize utilization that I could for my policy. Started on my second, and I'll only tell you guys based on my own experiences and what I personally do. So we're here definitely to talk about IBC, and if I know it, I might tell you about it, but we're not finance advisors or anything like that. So I'm just speaking from experience when I talk. Look forward to answering your questions.
Well, we don't have any questions. This is the first.
Ooh.
So, yeah. So, guys, if you have any questions there, go ahead and put them into the chat box. But I'll get it rolling with a question I've had. It came from the Take Back Control Tuesday event and some calls that I've been having. So, a lot of people in their mid to late 70s are looking to get into infinite banking somehow. They're trying to see if it's a fit for them, that kind of stuff. So, I guess I'll start with you, Jason. How would you answer that question for someone who, let's say, is 75 or 76 years old?
75, that's pretty good. We can probably help them. 76, I believe there's one of the mutually owned dividend paying whole life companies that we might be able to help them with. It's really finding out, Brian. I mean, we say the same things all the time, but it's really finding out, what are they trying to accomplish? Is it a legacy play for them? Is it they're just trying to make sure that they want to teach that? Like, what I'm finding a lot in those conversations, Brian, is people want to teach, well, I've got 4 kids who are pretty successful, but they're terrible with money, but I want to make sure my grandkids are taken care of. And they start seeing this idea of legacy right at the end of the 4th quarter. So it can be challenging for sure, but right. I don't know. I'll leave it at that. Anybody else?
Well, I would say that, the challenge with that is that it's called cost of insurance. What that means is that when it comes to infinite banking, we're using whole life policies, but for every dollar that you put into a kind of life insurance policy, you're going to get a certain amount of death benefit. When we're 30 years old, you put in $1, you'll get, let's just say, $100 of death benefit. When we're 75, you put in $1, you're not getting $100, you might be getting $10 of death benefit now all of a sudden. So what that means is to get the same amount of death benefit in a policy to work for infinite banking, you got to put in a lot more premiums up front to get the same result. So it's not as efficient. And then once you hit, typically it's 75 with most companies, but sometimes 76 or 74, you can no longer use certain riders inside the policies. They don't allow them anymore. And those riders are what we need for infinite banking. So it becomes a challenge at a later point where we just can't do it. And it probably doesn't make a lot of sense. The other thing, though, you got to keep in mind is you can always do policies on somebody else that you have insurable interest on. So a lot of my clients right now, they're grandparent age, they're actually looking to do policies on grandkids. So small policies, they can do those. So it depends on what you're going to do. Like Jason said, it depends on the outcome you're trying to accomplish. But very common question I get. So with that, I still don't see any comments or questions in the comment box here. What is going on, everybody?
Shocking.
Dude, are we even live?
I know we're live. I can see it.
Everybody's frozen. That must be it.
Yeah. The cold is sweeping the internet's going too slow now. But yeah, go ahead and get those comments in there. If anybody has any questions, anything like that, or typically we see questions from what's his name?
Dexter.
Yeah, Dex is usually in there. Shane's usually in there. Main Boo says, y'all been teaching too well. Well, that's one of the bigger challenges that a lot of times that, the questions we see, we've pretty much seen every question before. There's not a lot of new ones. They're just maybe different structures and coming from somebody else. They have a different viewpoint. But that's one of the challenges. We've seen a lot of the questions. Yeah, Tony says, Linus and Tess have answered all of my questions a bunch. Exactly.
And Brian, that's a good point. Let's maybe talk about this for a second, if everyone's open to it. So, I look at what we do as educational based, right? Chris is always talking about give away your best stuff for free. Your education, your knowledge, your ability to solve someone's problems. That's what we're here for. We're really looking to add more value by solving problems. Now, I think where this gets a little tricky is not everybody is ready to have their problem solved. Not everyone's ready to receive the information. So one of the big pivots I made for myself personally this year is I'm not really looking to educate anymore as much. Like we'll keep giving the education, keep answering the questions, but it's time to start acting. It's time to start putting this in motion because nothing happens without action. So are you ready? Like, are you following the simple laws of money? Are you following paying yourself 10%? Are you spending less than you make? You know, are you doing some of the things that just are common sense, which is that's not very common, right? But are you doing some of the things that you need to do to even have the opportunity to implement this system? Because not everyone can get approved. That's one thing I'm noticing. I've had 3 or 4 people in the last week who wanted to do this, and at the end of the day, they weren't approved,
Yeah.
you know, for something that would work for a banking policy. So
I like this comment here. Brent says, why don't you provide some info on the sessions you're doing this weekend? Yeah, in a little bit, I'll have a slide deck actually on the event. I'll just bring it up real quick and run through what the event's going to have, what we're talking about on the event, and that kind of stuff, because there are some really cool speakers that I'm pretty excited for.
we got a question. Thank you for Medina's martial arts. That's awesome. I don't know if you saw that one.
Yeah, I did. Yeah. So I'll go with this one to start with. Declared Ruler says, what was your biggest hurdle that you overcame before you started with infinite banking? Ooh, that's a good one.
I got out of debt from paycheck to paycheck in the first 8 months.
My biggest hurdle was actually it wasn't a hurdle. It was an absolute obstacle that I didn't realize was there. My biggest obstacle was I when I first wanted to get life insurance or a policy or something like this, I went to my buddy. Did you not? I went to he's a financial advisor, by the way, and he gave me a variable universal life policy that was higher commission and crap with cash value. So my biggest hurdle was I didn't have the right advisors to help me or the right experts like us, by the way, which it was one of the reasons why I became an infinite banking student was because of that experience. So yeah, having the right person on your side, that's a big part of it.
Going off of that, that's exactly what happened to me. It made it more difficult because I wasn't properly explained on how to fully utilize the policy. So the only reason I was able to get out of debt in a faster timeline was because I was trying to run more of my income through it via loan repayments quicker than I normally would have, just so I could utilize it again towards the next debt. And I realized that person wasn't fully in my corner. And I come across that a lot. That's a common thing I hear from clients.
If someone's telling you, thank you both for sharing. I didn't have a horror story, actually. Mine was really good because a guy I learned directly from our Nelson Nash back in 2005 and 2006 and has been practicing since 2007. And he's actually a fiduciary with 40 wealth management offices. So I guess I got lucky. Blessed to have someone hand me Nelson's book. But I do get this a lot on calls, especially recently, like, hey, I have this policy and, you know, I wanted to go back to my agent at such and such company. And it's usually not one that supports the infinite banking concept. And the response they typically get from their agent or their broker or their money manager, whatever, financial advisor is, oh, I can do that. I've heard of that. I'd be very careful. You just heard 2 people tell you the problems they've had when companies aren't set up for you to take loans and repay back loans and to really understand the structure, the specially engineered part of this. You want someone that's going to be able to engineer this for you, not just as a one-off, but something they think they can do. Because that's when you're going to run into trouble.
Yep.
I can add that too as well. I can add that as far as mine started with an IUL. I researched a ton. I thought I was doing the right thing, ended up having not very much cash value in the beginning. And obviously later on finding it was really more about the commission. As we kind of started, we did start it more for death benefit in the beginning, but obviously we wanted to use it for more retirement. And as we continued to look into more illustrations and find out more information about it, and then obviously getting involved, with the BYOB, school and Money Multiplier, you'll find out the education is very different and the information is very different in a good way, right? We're learning more about something you want to have something for the rest of your life and pass on to your family. But the way that it was built, the agent that we were working with, we kind of either retired or fell off the map. We haven't talked to him. And obviously just kind of set it, forget it. Hey, see you later. Don't talk to you ever again. And that's just completely different with this team. That's another reason why we're part of this team. It's just how well we communicate, how well we continue to stay up with things and help you throughout not only the beginning parts, educating you, but then once you get your policy, how do you use it? From there, what are you using it for? And then continue to solve your problem. At the time I got the IUL, hey, yes, it was for death benefit because somebody I was working with actually passed away. I got out of the military. I was like, hey, I need death benefit now. And then we looked at it more as a retirement vehicle and ended up getting that IUL. So luckily we're able to 1035 it, turn it into a nice whole life policy that'll guarantee me and my family for the rest of my life.
There you go. Love it. Love it. All right. We're going to go with Medina's martial arts question here. So, hey guys, first time here. Welcome. First off, super new and inexperienced. What's the process of paying back the loans to the insurance company? Thank you for everything. So, anybody want to walk through? Lynch, you want to walk through the process of paying back the loans?
Yeah, the physical process of paying back the policy loan, making policy loan repayments is fairly simple. Typically, when you take a policy loan, they're actually going to mail you a form that you can fill out and send back to have them automatically draft from your bank account whatever monthly policy loan repayment you want to make, if you want to do it that way. So that can be a great way to automate it, just the same way you would pay back a bank's money, right? But it's also possible to do one-time policy loan repayments manually online, or even by calling the carrier. Those things are fairly simple, sometimes even simpler than paying premium, or the same. But yeah, there's kind of more to it, because when you're paying back your policy loan, so actually, let me back up. You took a loan from yourself, and now you're wanting to pay yourself back with interest like you would have paid back the bank. But since the policy loan interest is a simple interest, it's not amortized, and you're paying it back on a good schedule, or you should be, or basically whatever fits your cash flow. All of the money that would have been paid back to the bank won't fit back into this policy loan repayment. So some of this policy loan repayment over time is going to end up needing to go into the premium side of the policy. And that's then the PUA premiums. And so whether your policy was actually designed to take extra PUAs may be the first question. You can always call the carrier or work with your implementation specialist to find out about that. Hey, how much extra PUA premium can my policy accept right now without becoming a mech? That's important. And then go from there.
Yep.
Great job, Liz. Medina's martial arts, I would just say, have a plan to pay it back. If you're going to run a banking business, have a plan to pay it back. When you're taking the loan out, you should already know, hey, I'm going to pay this back monthly. I'm going to pay this back when this sum of money comes back, like a big amount or small amount, or hey, this money's going to be out working longer, so I'm going to pay at least a simple interest. Just follow Nelson's third rule and don't steal the peas from your own system. Be an honest banker. And that's how we're going to guide you every single time.
Yep. And then one thing to also keep in mind on the policy loans, you can pay it back tomorrow, you can pay it back 12 months from now, but you can always, and I didn't know this, you can actually have the bank, or the bank, your bank, the insurance company, do like a monthly payback, and you're it's hands off. So you don't have to log in every month to schedule payment. You can actually fill out a form, and then they'll just do it every month for you if you want to do it that way. It makes it a little easier. But does one ever do that?
When I do it is a bit different though, because if you're utilizing a HELOC, we run our system just a wee bit different because we're looking for leverage and arbitrage, and we're utilizing the HELOC as the point of savings checking, if you will. So we run the money through the policy, and we do take it out on loan, because mathematically, if our HELOC is 8% simple interest, or some people have seen it drop to 7% right now, and our loan borrow rate is anywhere from 6 to 7% interest, and then we're also earning dividends on top of that, it kind of negates it a bit to where the 8%, 7% we're saving in the HELOC by having the funds there and still earning the dividends in the cash value of the policy. It just makes more sense to keep it in the HELOC, but that's on a case by case. So.
Yep.
Yeah, I would agree 100% on all that stuff. Very similar in my experience. I do very similar stuff with Joe and yourself, Bree. But as far as this gentleman or this person's talking about, they're very inexperienced.
Yep.
So
Yep.
maybe more of a recommendation, or I would say a suggestion would be more of maybe doing kind of like what Brian said with kind of like the auto pay, something kind of simple so they can kind of see how it runs, kind of making more of the velocity banking inside the policy with a lot of premium.
My first one, it was started off a monthly premium. 7 days in, I was borrowing a small amount because it wasn't a big monthly premium. And I took that loan, applied it to a debt. And in the second month, rather than paying what was going towards the credit card debt, I made the whole loan repayment. And that turned a reversal on the interest rate. So I wasn't being charged the annual interest for borrowing the funds. And I paid it back quickly, faster than I might have by doing just a monthly, because I knew I was going to utilize it again towards the next debt. So it was kind of planning beyond just that first step. What are the other birds with the stone we can still carry?
Yeah. And another way to look at this question is, we'll rephrase the question. So one of the questions I get a lot is for people, this is people that are even doing infinite banking and saying, well, Brian, how should I pay back the loan? Should I pay it back monthly? Should I pay it back annually? I mean, how should I structure the loan payment back on it? So the way that I answer that question is that structure the loan payment based upon what the money is doing for you outside of the policy. So if you're buying a car, as an example, we'll just mirror a traditional car transaction, which means you get a loan, it's monthly. If you're flipping a house, as an example, in real estate, and you're putting all your money into this house, there's no cash flow. So I wouldn't pay back the loan because there is no cash flow because the money's not doing that. When I'm done with the flip 6 months later and I get a big cash infusion, then I'd pay back the policy loan in one fell swoop. If I'm investing into a rental property, which provides me consistent cash flow or additional cash flow, I would take a percentage of that cash flow, put it back into the policy loan. So I'm just mirroring what the money is doing for me over here. If it's recapturing debt, I might not pay the loan back for 2 years or 3 years. I might pay the interest on it. Once all my bad debt is taken care of, then I take all that cash flow and go back into the policy loan. And we'll help you with that, by the way. But that's just a couple of scenarios where the answer is going to depend upon what you're doing with the loan. So,
very well said, Mr. Foots.
Thank you. Let's go this one with for Jason. So, Jason, can you give us a tiny piece of wisdom about the family constitution? That's on my to-do list for this year.
Don't miss. Here's a good time to talk about. And thanks for the question. This is something that's been near and dear to my heart. My question when I started this journey is just like, what the heck? I can't show up any earlier. I can't stay any later. I can't work any harder. Like, why do I feel broke all the time, even though I'm earning, nearly $200,000 a year? And that's when I found infinite banking. And then when I was protected and now I had the multiplication piece, right? The cherry on top we talk about, the death benefit. It really became a question of what happens when I'm no longer here, because that day will come at some point. What happens when I graduate? What's Patty and my boys going to do? Will they know the thinking? Will they know how I think about things? Will they know what we believe in as a family? Do we have that defined? And the answer was no. And so it's been a couple-year journey. And the family constitution, I look at that as the framing. To answer the question really directly, it's a framing on where do you want your family to go, the vision you have for your family. What are the values that you live by, and what's it look to live by them? What do you stand for? What do you stand against? And then you really get specific in all areas of life when it comes to the systems and processes you're implementing. And what you're really implementing is your thinking. Your thinking and your communication across decades. It's like a river. Imagine you have a bunch of small rivers or streams flowing into a larger river. Like when you start off and you're by yourself and you're in that little stream feeding in, over time, the Constitution becomes a live living document, and it gets stronger and stronger and stronger. The more you're communicating with your family, the more you're visiting these principles, the more you're having your family retreats to really revisit it, to see what needs to be revised. It's a living document. And as that happens, then you want to fortify the Constitution with a trust. Get with an estate planning attorney preferably one that understands infinite banking as a foundation. And then they're going to be able to guide you what kind of trust you need, usually a revocable trust. And I'm not giving any advice. We're not lawyers, so all the stuff that Bree said earlier. And then finally, the flourish part, the Rockefeller waterfall method, comes from when you pass on. The trust, being the beneficiary, receives the money, replenishes the system, but that constitution guides all of the thinking. So now you don't have entitled kids, you have empowered kids that understand. And so I'll be covering this for 90 minutes on Friday. You can't tell I'm a little passionate about it, and it's really where all I've been working on for the last couple of months, because it kept me up at night. And now I want to have everyone have the tool to be able to create their own within minutes, or if you want to take months or years, you can do that too. So
there you go.
Going off of that, our last call of the day, we've done 6 hours of phone time with him just in this first week that we got together. And that's because he already was given he already started his first policy. He's maxed out. He's coming from someone else, so it wasn't designed completely the best, but he's not going to give it up. Of course, we're going to utilize it to the full potential. And he's got a HELOC as well. And he inherited a property that's $300,000, wanted to buy out his brother and his cousin who received it as well. And he's in his late 60s. So he isn't able to get very much more death benefit for his human life value. And we were trying to go over options, and with limited income for his wife, different variables and things. He also has a business, and we were telling him, if it was us playing devil's advocate, what do you think of this type, running scenarios by him. And so he agreed because he saw the value in creating the family constitution. There's a map right here. They might be maxed out, but they have kids and grandkids. And if they utilize the HELOC to buy out the family and let them know they have an opportunity to still throw money back to the family pot, and he's able to go through and actually build out this family constitution and work on the ITIL, the intangible, policy, or intangible trust in life insurance. So that would mean having the trust own the policies, just like he was saying, so that when that beneficiary, or when the person passes, the beneficiary, being the family trust, gets to receive the funds tax-free and plan that legacy. The biggest way that the family trusts and constitutions have only ever gone wrong is because they didn't have a properly structured constitution. They didn't have it clearly mapped out. And that's why there's a huge split between the 1% of wealth who have been around for over a century, winning the game, carrying their wealth through each generation, versus everyone else who's restarting that wealth cycle every generation. It's critical. So highly watching whatever he has to say.
Bree, thank you for sharing that. Can I share one more thing on this just quickly? Is that okay with everyone?
Let's do it. Yeah.
This is, again, when we're talking about infinite banking and these specially engineered policies, it is an action. It is not we get it, it sits there, we don't use it. Like, we're telling you how to use it like a business. This is what becoming your own banker is. That's why our answers are always so long, because there's so many things you can do. When it comes to the Constitution, what really spoke to me is I've done a lot of different coaching for parenting, for dads groups, and it's just, you're always looking to be better, a better version than what you had. And this is 2.5 years ago. I was in a group and a guest speaker came in, super powerful speaker, uber successful, multi-millionaire. I would guess probably towards, $100 million, right? And he was sharing this story where he was leading this giant group of multifamily investors, and he has this huge team, and he was leading the whole weekend. And he was talking about how their values in the business provide guidance for when you don't have a leader around. They really show you, like, we believe in perseverance, or whatever it might be, or courage. And then courage looks like this. Courage looks like going the extra mile to help that person, even when you were afraid to pick up the phone or whatever, right? And he talked about this and how the business was so successful and how they're doing so great and the team's crushing it. And he had a buddy walk up to him at the end, and the guy's like, "Hey man, John, that was great. how many of these things that you're teaching us are you doing at home? And the guy just, it's like, oh yeah, I'm doing everything. Yeah, of course. Yeah. Like overemphasize what he wasn't doing, because the truth was his marriage was falling apart. He wasn't leading his kids. His kids were, not paying attention because he was never around. He's always working on the business. And so he got really intentional. He started taking action. He started just having the imperfect conversations. And then he told all these really cool stories about how his kids wouldn't watch certain movies. And you get calls from the family, of the kids, that his friends, and they'd be like, hey, John, why won't your kid watch this movie? I was like, I don't know. We didn't tell him he couldn't watch it, but it didn't align with their values. And the kids knew that. And so now his kids are all grown. He has grandkids. And that's where I got the idea of the river of values, because now the spouses brought their values. They built their own system. And now when they get together in these retreats and they all celebrate these things and they talk about these things, it's an action item. My whole point of all of this is nothing will ever happen unless you start leading it. It's a leadership exercise. So Constitutions, you can use the software I've built and we've built, and it's incredible. And you can have my Constitution with your name on it in minutes. But that's not what I would advise you to do. I advise you to go through each prompted thing, have the conversation, and keep going deeper and deeper and live it, right? It's a living document. So I'll leave it there, but it's an action item.
Yep. All right. Let's jump on this next one. So Robert, this is a good comment. I appreciate you sharing this, Robert. Says, I'm 50, lost my job, I'm broke. Restarting at this age isn't fun. I'd like to start later in the year. I'm assuming you're referring to infinite banking. Is it too late to use this method as a means to be my own bank? Absolutely not. I mean, at 50, yes, of course, starting over, if that means that you're starting over from a career or don't have any savings, either way, I mean, it can help you accomplish those things. When we're later on in life, sometimes we do want to accelerate it a bit more. So there are ways to accelerate infinite banking by doing additional dump-ins or structuring it certain ways. But so when you feel that you're in a situation, and I would recommend maybe even before you're there, but that, hey, in 3 months, I'm going to be in a place where I can do this now. Start the conversation potentially before that time, so we can start answering questions, start helping you get some more information, making sure that it is a fit, know your numbers, all that kind of stuff. I do have a lot of clients that they said, hey, it's not a fit right now, because it's not a no, it's a when. So there's not a fit right now, but hey, Brian, it's going to be a fit in about 3 to 6 months. But I want to make sure that I get my questions answered right now, so I know what it's going to look like when I am ready. So that's what I would probably recommend for you, Robert. But just keep learning, by the way. You're in the right spot just by being here and asking questions.
You're already doing something most people won't do. And do the first job Nelson Nash would tell you to do, which is go make money. To be in this country and to do everything you need to do, you need to go and add value and earn money. So that's the first job. Once you have that figured out, like Brian said, keep learning this. And then it's just a matter of, when are you ready? When do you have your system where you can start paying yourself first? You're making enough money where you feel solid, because that'll really move things for you.
Yeah, for sure.
I think it's incredible for the sake of him just saying his situation. A lot of people don't have that courage to bring that information up. And as far as some people say, hey, am I too old? Right? There's definitely at 50, you're not too old. You got to start somewhere, and start with obviously making more. Start with keeping track of all of your income, all your expenses. What can you get rid of? What can you look into saving? And then create that system that they're already talking about. And try to make it automated. So it's something you're not actually thinking too much about. If you're saving 10%, boom, as soon as you make that money, boom, automatically send it to, let's say you're just, for example, a savings account, and then, hey, after a whole year goes by, then how much, hey, I have left over and I've saved, then then you could start kind of using it for that policy. If you kind of set yourself, a standard of living and income minus your expenses and whatever's left over, and or different ways to save, right? But you got to start somewhere, and I just want to commend him for coming on here and sharing that. And this is definitely the right place to be. There's so much wealth of knowledge on this team and all the webinars and everything. There's a lot of information, and it's all free, right? We could just jump on YouTube and just learn as much as you can. You know, you're doing laundry, you're doing dishes, just listen, right? Just continue to be in the campfire, listen as much as you can, and you will, if you take action, you will be successful.
Yeah, great time. Brian, if you're able to drop the link in there where people can actually go to schedule a call with one of us here on the screen, or one of us on the team, and happy to go through your situation in more detail, answer all the questions that you may have, more details and stuff, and give you more specific education maybe as well too.
Yeah, I'll put that here in a moment. I want to grab this question real quick from Maiden Blue. She says, we have a large purchase to make this year. We were going to borrow from a 401k, but trying to figure out if we should run it through a policy first. I think it would be painful in the beginning that way. So I'll let someone else take this question. I'm going to go ahead and put in the comment box here in a moment. I'm going to put in the link to schedule a call with one of us here, with one of our mentors.
Yeah, she also wrote in there, but I think I just need to sit down and run scenarios in the vault. So yes, definitely a good idea there.
And that's definitely the math for you for sure.
If you haven't had a call with one of us, it might behoove you to have a call with us first, because there are, I mean, just with what you said there's about 3 different ways you could do this right off the bat. There's probably even more than that, because there's a short-term view and a long-term view. Obviously, the short-term view is going to be the one that you're going to see right off the bat, but the long-term one is the one that you might miss down the road not having it in place. But it really depends upon your cash flow, your situation, and that, because you can borrow from the 401k and do the purchase, pay yourself back. 401k in the policy loan to purchase. But now you've got a 401k loan and a policy loan. So you've got 2 different debts now, along with the premium that's going in as well. So once again, long-term, that method right there is going to make a lot of sense from a long-term perspective, but it doesn't matter if it makes sense to me. It has to make sense to you and your numbers.
I'll give an example. I'll give a specific example. So I have someone who's just starting his policy, and here I'll even open it up in the vault so I can actually give you like real numbers as I talk about it. But this individual makes good money. He does save. He puts a lot of money in qualified plans. And he has a fair amount of bad debt that's kind of stacked up in the last year or so. And it's mostly high interest credit cards. And so what he's doing, like he's paying an average of 16.72% amortized. It's 86 grand in debt. He'll pay the banks, if he just does what the banks want him to do, $51,000, and he won't be done paying off the debt until 2032. So what we did is we took a loan from the 401k. We found what he wanted to do on an annual basis that made sense for his income, for his scenario. We built a policy so it has that flexibility of going down to the base in bad times, and you go up to the ceiling, what it's designed for every year. But once we put this in place, he'll be out of debt in 26 weeks. He'll recapture 32 of the $51,000 of interest by just taking a 401k loan, and instead of continue to contribute to the 401k, he's just paying that loan back. So he's recapturing an average of, 16.72% that's guaranteed back from paying other people versus having that money working in the market where it's not guaranteed, where he's not recapturing this. So that's a simple way that we can model stuff like that out for you, Maiden Blue. So,
and then just a little 2 cents history lesson on that. There's a great book called The 501k Plan, because retirement plans are relatively new. These policies have been around since 1845. Traditional banking with fractional reserve system has been around since 1913, when the currently named Federal Reserve was created under a different name. So the IRA came out in 1974. The 401k created by Ted Benna came out in 1978, and that's the same year my husband was born. He doesn't manage the money, so I don't really associate my money with the 401k. And then the Roth IRA came out in 1999, which is younger than I am, so not inclined to put it there as much either. But the 501k plan actually has some words from the creator of the 401k, Ted Benna, And in it, he called it a monster once the government had gotten a hold of it and turned it into something unlike what he intended. His recommendation, of course, in that book, I would go read it for yourself, was that you put money into your 501k plan, just like he does. The 501k plan is one of these properly structured, high early cash value, dividend paying whole life policies with a mutually owned insurance company. So that's my retirement plan there. We've had clients and agents actually that have utilized leveraging their 401k because, like Jason said, it mathematically made sense for them to use it to start their policy and do other things. But it's a case-by-case basis. So anyone considering a 401k, do some more due diligence. But anyone already there, just numbers, run the math.
Just read the book 401 Chaos. That'll be fine. Pay with the Chaos, by the way. That's by Andy Tanner, who knows Ted Benna. So great book. Let's go to Craig's question here. So assuming maximizing paid-up additions, PUAs, is paramount for cash value, I've also heard that with some policies, the first-year PUA can set the tone for future PUA availability. Is that true? So yes, yeah. PUAs are what fund the cash value, so they're what you want to put in. But yeah, I mean, you can affect the future PUA availability by the first year. But yeah, Linus, you want to explain that?
Well, time is a very important piece of the equation for compounding. The sooner compounding starts, the bigger it gets sooner, if that even makes sense. So yeah, the more you put in earlier, the more efficient, faster the policy gets. That's kind of how I would say that. I guess another piece of it with some companies, they may limit your future PUA premiums according to the average over a certain number of years in the beginning of the policy. Yep. So, I mean, it's kind of different than your question, but it may be also part of what you're asking. So maybe there, depending what company you're with, you may need to be aware of what the average PUA funding is that you're doing over the first number of years, depending on the company's rules, because that's going to set kind of your limit for years further into the policy then.
Yeah. I mean, another way to explain this is a very simplified explanation for just simplicity. It's not exact math, but let's say that you have a policy, and let's just say that over the years, the next 20 years, you're allowed to put in $100,000 of paid up additions. Awesome. You put in a certain amount per year. There you go. You can't put in 300,000. You can't put in 2. You can put in 100,000 of PUAs over the lifetime. But what if you actually, instead of putting 100,000 over 20 years, you put in like $50,000 or $30,000 day one of PUAs into this thing? So all of a sudden, you've taken a lot of that PUA that's over 20 years and you put it in the very beginning. Now you might not be able to put in PUAs for 20 years. It might only be like maybe 10 years now, because your policy can hold a certain amount of paid up additions, whether it's all up front, spread out over 20 years. It's generally speaking, a certain amount can go in. And how you structure that to go in is what dictates, how long you can put PUAs in for. But once you start to understand infinite bank, understand the PUAs a bit more, that answer might make a bit more sense. But whenever you build a policy, it can hold a certain amount. Put it that way. Pour it in slowly, pour it in fast, same amount, generally speaking. So, and it's kind of funny. We did a thing. I can't remember. This was last year. We ran a scenario where we were doing that. We were spreading it out over time, doing it all up front, and it was close to the same amount of PUAs. But the one where you put it in up front has more dividends compounding earlier on, so it's a lot more efficient. So that was kind of fun to do. And then Craig, I'll take this other question from you. So you're talking to your daughter about a family constitution. I love that. It's awesome. Talk to your kids about it. Teach them this. She's hesitant because she thinks her brother's a butthead. Have you seen Constitution to deal with children who don't get along? I'll speak from my personal experience, and then I want to hear what Jason has to say, but I want to say this one first. Just because you have a family constitution does not mean that every family member is tied to it or involved in it. If you have a family of 6 and one of them just is absolutely contentious and doesn't want to be part of this, doesn't believe in this whole thing, they don't have to be a part of it. You want them to, because that's the whole purpose of legacy, involving your kids, but they don't all have to be a part of it.
Craig, that I love the question. There are, depending, what I found in the research when we were creating ours is a lot of family constitutions, a lot of the literature out there are more geared towards families that have large businesses or have businesses that they're looking to pass on. It's like a way to keep legacy going in the business and have that system and process to pass on the business. The way that I've personally structured what we've created is based in your vision and your values, because everything's changing so fast, and every kid's different. You don't know what they're going to be when they grow up. So what we can really give them is the thinking. And then a lot of family constitutions will have, how do you handle conflict? And, they might even have resources like, hey, we handle conflict by speaking to each other this way. And there's some guidance in this one like that. But yes, you can add that as one of your articles on how you handle family conflict. It would also come from your values. If kindness was one of the values, like the two things that say on my board downstairs, we have a giant like 4x6 board. It says, do it now and be kind. So when I hear the names butthead and, those things being thrown around between the boys, I'm like, hey, be kind. Look at the thing. Don't call names. Right. I mean, we grew up where that was normal. I mean, 80s kid, like there's lots of names called and lots of things that you can't say today that we did. That still, I turned out okay, but still you can structure and use your constitution to guide those type of things. And again, it's not going to be like, hey, look at this big document. It's going to be like, hey, let's have a conversation and why calling your brother a butthead's not cool.
Have you ever seen the movie or the game Mortal Kombat? That's where you put those kids.
I actually got to play Connor the other day, and I was kicking his butt. I was pretty proud of myself. Those are the games I'm still okay at. You can go back and forth like this versus like all the games now. They're much harder. So.
Yeah. So Craig had a follow-up question to his PUA question. He says, thanks. What he's worried about is if I don't max out PUAs early, I'll limit what I can do later. Actually, it's not. It's kind of almost the opposite of what would happen. If you just put in the PUAs in the early part, you can put them in down the road. But if you front load it with a lot of PUAs, then you actually limit PUAs down the road. It's actually the opposite kind of happens. Yeah.
It's Craig, if you get to that point, that means that you're doing really well. Yeah. Like that's kind of, I think that's a goal. I haven't seen anyone max it out. Like this is one of the ways I teach banking is how do you add extra PUAs in after the policy is already in force. And I teach it because I want people to be active. The word of this whole thing today is action. So Craig, if you hit that number, just high five yourself. You're like, okay, cool. Now my policy is max efficient it could ever be. I can't get anything else into it. Now I got to expand my wealth warehouse. How do I have another insurable interest, or what do I do now? I mean, Linus, would you agree with that line of thought?
Yes, I do. Something I would add though is it's very company specific. Even with kind of the MEC limit kind of stuff in maximum PUA funding. So one company might basically operate or turn out opposite than the other in this part of the conversation. What I would suggest is sending your implementation specialist your illustration or illustrations if they don't already have it, and ask specific questions about how that PUA funding works. Or I'm also happy to give you some specific info on your specific policy or policies on how that's going to work out. So yeah, my email is linus@themoneymultiplier.com.
Yeah.
Ryan, could we go to that question there about the bad debt?
Yeah, we have 3 more questions we got to get through here. So let's go through this one. This is Roy. It says, if I'm trying to pay off bad debt credit cards and I have maximized my policy, should I pay back the loan from the policy or put my extra money towards the debts? That's a great question. Where's
Bree's got it.
I was going to say, I would personally make the decision to pay back my loans, because if it's less than a year, even if it's out a year, I could potentially be reducing that interest rate. Either way, I'm refilling what's accessible from my cash value pot to actually go and take that loan out again and then pay the debts.
So, and what I would do, my answer is different. If I have credit cards that are at 20-30% interest rate over here and I've got freed up cash flow, I wouldn't put it into the low interest debt, which is the loan. I'd put it into the high interest, which is the next credit card debt, to accelerate the payoff of those. That's just how I do it. If I'm doing velocity banking, I'm going to run my income through my policy anyways. But if the way we do the debt blast in our software will map it out, though, typically is you pay off one debt and you've got more, you take the cash flow that was going to that one credit card debt and you roll it into the next debt to pay that one off even faster. That's called the snowball method. But I mean, it's
and that's where my velocity one changed a bit, because my first debt was only like 165 that I paid off with that first loan. And that $25 a month wouldn't have done much hitting the 300, but it was my second month's premium. So now I could put the loan back into, pay it out of my income back to the policy. And then I took out 300 and tackled the next debt. And then the following month I had 300 plus my monthly premium that I paid back and took out a bigger loan and tackled the next debt. So
it's just math.
Months. It's going to depend.
Yeah. So Roy, we have software that maps it out, because it can get complicated, but once the math maps it out for you, the math maps it out. Yep, that's right. For you, then just follow the plan. I mean, that's pretty much it. So that's why we have the Vault software. It's for that reason. So there you go. Can you convert a whole life policy from Mutual of Omaha? Maybe, probably not, but depends on why you're doing it. So it's kind of a 50-50. What this person is referring to for everybody else is a 1035 exchange, where you roll a whole life from one company to another company. But you'd only want to do that if the existing whole life is very inefficient, is not serving your purpose, and it is not set up for the way that you want it to function. But we'd have to look at it first to be able to answer that, to help you decide that, because it's your decision. But we would just have to look at the illustration of Mutual of Omaha and see what the options are. But yeah, I mean, if it's been around for that policy, if it's an older policy, it's probably going to be pretty good to leave it as is, by the way. But it just depends on when it was set up. Rick Carlson, official. He's official. Best sources to learn and possibly get licensed to help people and myself build policies.
Welcome. You found us.
Yeah. Well, when you say build yourself policies, if you want to build yourself policies, you just got to go get licensed and then get appointed with an insurance company that can do infinite banking. But what your question really is asking about is, how do you get experience or get mentored for infinite banking? So one of the places to go check out is the Nelson Nash Institute online. So to go Nelson Nash Institute, and you can go to their website. They certify infinite banking practitioners like us. You don't have to be certified to do infinite banking. It just means that you've gone through their training. But they've got a lot of resources there. Of course, go to Chris Nagel's YouTube channel. A lot of resources there. But getting licensed is just state specific. You just got to go to your state licensing website, and they'll tell you the process to get your license for that specific state.
I only said welcome, we're here, because we've had a number of clients that have asked that same type of, well, not the first part, but asking about getting licensed and being able to help people like we helped them or they helped themselves. And so they end up just joining. I help them find resources depending on their state for training to get the license. And then they do their everything on their own time when they're ready. And if they still want to be part of the team or learn from our team, then they kind of join in with us and provide training and stuff for them to be.
Do we say you got to practice first? You got to practice first.
Absolutely.
Okay.
Exactly.
Practice first. Yeah. Get someone like us that is a certified infinite banking practitioner to help you go through the process. Don't try to figure it out on your own and do it yourself and do all that. A lot of people come to us. That's a failed plan. Go ahead and come to someone that knows what they're doing, have them do it for you. Now you know what it looks like. And then from there, go ahead and get your license and do everything else.
Amen. Yep.
Yep. All right. And one last one right here. So Skull says, referred to the Mutual of Omaha, it's a new policy. So, I mean, I would just recommend scheduling a call with one of us and just discuss what concerns you have, help us analyze that policy for you to see if it's infinite banking, structured, all that kind of stuff, and then gives you the pros and cons of your current setup and who you're with. So, but yeah,
something else I would say just for everybody, I guess, a lot of times policies from Mutual of Omaha are going to be a type of universal life that does not work for infinite banking, and often people just don't realize that whole life is whole life. Whole life may not be true. Like there's products like IUL and other types of universal life that are often called whole life when they're kind of technically not. They're called permanent insurance, but they're not really guaranteed for your whole life. And so just kind of throwing that out there. Not all permanent insurance works for infinite banking. There's a fairly narrow set of companies and products that work well for infinite banking.
Yeah,
On that, IUL is indexed universal life. So it is a universal life type of insurance, not whole life.
That's kind of interesting. Someone sent me their illustration 2 days ago. It was an IUL, and they said, "Oh yeah, this my mom's friend set it up, and it's she's the greatest thing ever. She uses it in her life and all this kind of stuff, and best thing for retirement." And he sent it to me. Guess what happened at age 80? And this is gone. It's toast. And I'm like, "Hey, do you see where it says lapse all the way across the screen?" He's like, "What does that mean?" I go, if it doesn't hit the best case scenario, which is like the 1% chance of probably happening, it's going to be the average or the assumed average right there. That's probably more likely. If it does hit that, you're to lose the policy at age 80. You'll lose all the cash value, all the death benefit. It'll collapse. He was not a happy camper, and guess what his premium is per year?
A lot.
$200,000. $200,000. Now, granted, he just put in one premium so far, so we're saving it. But when he saw that, he goes, "Wait a second! I thought it was a guaranteed." I go, "No."
How big was the death benefit? Do you remember how big the death benefit was?
Oh gosh, it was at one point it was like $10 million.
Okay,
at one
that's
point.
good.
Yeah, so imagine having a $10 million death benefit during the life of a policy, and then you look at the paperwork and it shows that it's going to go to zero most likely. You're going to lose the whole thing. Yeah. So just be very, very cautious. If you're doing those kind of policy illustrations, make sure you understand the numbers, because this gentleman, the agent, never explained that to him. And he's like, "Wait, what?" But she said I could take out $400,000 per year at this point in time, only if the markets perform the best they've ever done for the next 40 years.
How about this, everyone? Let's make an agreement with not only your panelists here, this awesome crew, but how about everybody listening? Let's make an agreement. When we go into things, we're going to slow down a little, and we're going to start looking at what the long-term outcome of whatever that decision is. Right? We're going to think long range first. If you do that, you won't be getting into scenarios like Brian just described.
Yep.
Because you look at it and you'd be like, "Wait, why are there zeros at the end?" Like they were not directed very, very well by whoever helped the broker that helped them to get that going. So think long range.
Yep. All right, guys. So we're at the end of the time here, but I'm going to spend a few minutes really quick. I'm going to go through a few slides, just showing you guys the topics that we're going to be talking about on the 3-day event. So that if you guys want to, know what those are, or go to because they don't say every single event or speaker on the link. So I'm going to share my screen. Okay, this is goofy. There it is. All right, so I'm going to go through this pretty quick. Just to give you guys an idea of what we're going to be talking about. So this is day one, by the way. So day one, the first thing we'll be talking about is money, mindset, and framing with Noah Harris. We're going to talk about becoming your own banker with Hannah Kessler. I've seen her presentation on this. It's going to be a great one. I really like this one. Eliminating the 4 wealth killers, because there are things that do destroy wealth. And if you know what those are, you can stop them. It's going to help you build wealth a lot faster. This one is going to be PMC Wealth Advisors with Brandon. And I think it was, who else is doing this one?
Stephanie.
Yeah, Steph is doing that one. So we have PMC Wealth, which is our financial advisement arm of Private Money Club. It's not publicly out there yet, but it's we're getting it going, and they're going to be talking about the services they provide, which are going to be alternative advice that you're not going to get from a traditional advisor. And then we're going to do a Q&A panel, just answering questions live. And then the VIP session 1 with, I don't know, who's speaking on this one? Mr. Jason Stiffel, the family constitution. So I know some people were asking about that. And so Jason's going to be doing a special VIP session going through that in detail. Day 2, integration. So connecting mindset to money problems. That's a big thing for a lot of people right there, by the way. Student loan debt strategy. So this one, so Rachel Katz, she has a method of getting rid of student loans faster than you would expect. This guy right here, nice hair, is doing policy structure and design. So I'm going to go through how we design these policies, what makes them infinite banking, so that you can understand the ins and outs of the policy structure. Craig and Mauricio are going to be going through the vault and the advanced markets. So this one's going to be fun. They're going to go through how the vault can really help you accomplish your goals a lot faster. Mr. Joe Kovacevic is going to be going through, or HELOC Joe, as we should call him, velocity banking and infinite banking. So how those two concepts work together. So if you have debt, you're definitely going to want to tune into this one because it's going to show you how to do multiple things together to pay off debts a lot faster. And then Tess, you better not be sick when you're doing this presentation, by the way. Got to get that voice taken care of. So she used to be on the inside of the insurance companies for 20 years, and she was a skeptic around infinite banking. Think about that, a long time. And she became one of infinite banking's on our team, one of the biggest advocates, and now uses it and helps other people use it. So really good story from, mindset and how she changed. And then another VIP session. So this is going to be implementing the family constitution. Jason, are you doing this one with Brent?
No, that's Brent Carlson. It should be.
Okay.
I don't know why I have my picture there, but that's cool. Look, I'm there again.
There
Brent Carlson from Corporate Capital will be doing this one.
Yeah. So Brent, they do a lot of stuff on the estate planning side, business planning, tax strategies. So they're going to show you how to implement what Jason is talking about legally. So through all the paperwork and the documents, all that kind of stuff. Last day, day 3. So Brent is going to be talking about asset protection and how that works because it can integrate with infinite banking very well and obviously generational wealth. Then Steven's going to be talking through the Private Money Club platform and our success team over there that can help you become a private lender if you want to do that. Why to invest in resort land. So Michael Paggi is a good friend of mine, known him for 8 years now, 10 years, something like that. And he invests in land. No tenants, nothing like that. It's just land that you can buy and sell and make cash flow out of. Pretty cool strategy. Kevin's going to be talking about real estate note strategies. I used to do notes, so I'm going to be tuning into this one because I haven't done them in a long time. And Kevin, I've heard some really good things about him, and we got some people that are using him right now that are really happy. Noah Harris is going to talk about Private Money Club and the accelerator curve, how you can really scale on that side of it. This is probably one that I'm really excited for because I've done not low-income housing, but affordable housing before, and I want to get back into it. So how to invest in mobile home and manufactured homes because they are treated different than traditional real estate. And then the bus and tour turnkey, I'm not quite sure what we're talking about in that one. That's going to be with Stephen, I believe, as well. And I think that might be it. Oh, and then the final Q&A and close with Chris and the team. So that is what's going to be going on the 3-day. And then, Anna says she works with Kevin. So there you go. So that's going to be a great 3-day right there. I'm going to go ahead and put the thing in the chat again so that you guys can grab the link to that. Definitely go check it out. It's going to be a fun event. You're going to learn a lot, and there's going to be a lot of opportunity, I believe, through that event as well. Yeah, 401 Chaos with Andy Tanner. That's a great book, by the way, and Andy is hilarious. We had him on the Wealth Wednesday webinar, and basically he just peeled back the whole thing on 401ks and destroyed them. It was a lot of fun. All right, so I know we have some other questions that came in. If we want to answer those real quick, we can go ahead and do that, and then we'll let you all go. Coach Stormin Sims says, do you pay your credit cards directly out of your segregated account from your policy? I don't know. So I borrow the money into my separate account, and then if I'm going to pay a credit card, I move that amount into my checking account, so it keeps it all separate. So I only have anything tied to that segregated account that is infinite banking. If I want to use it for something else, I may move it to another account, but I keep that very clean. That account it's very clean.
And that's why we call it a segregated account. We keep everything separate for the policy stuff.
Yeah. So that's that. The 401 Chaos with a K. Thanks for putting it in there, Linus.
And then mine was the 501k plan, how to fully fund your own worry-free retirement. Tom and Mark Ford Dyson.
Yep. Has anybody done a land deal with Michael? I saw the presentation and they were interested. I've had dozens and dozens of clients work with him directly, personally. I have not done a deal, to be honest. I just haven't had the opportunity, but I've had lots of clients and friends that have worked with him and all have been very happy, very satisfied with it. A lot of them are using 401ks, by the way, or sorry, IRAs, self-directed IRAs, because it's a very hands-off concept. So they put it there because it's very hands-off. You don't have to worry about it. You just buy and hold it, or buy and turn in the cash flow. But, like he's been doing it for a long time too, and he'll share his story probably. Yeah, but he's been doing it for a long time. I think 30 plus years, something like that. So quite a while. Well, cool. Well, we got to the end. Another Ask Me Anything in the books, and right before our live 3-day event. I'm hoping to see a lot of you on that event, by the way, and see all your questions and all that kind of stuff. I know we got a lot of I see some names in here. I know they're already signed up, so that's cool. But looking forward to it. All right. Well, with that, we'll let you all get back to it. Any last comments?
Nah, thanks all. We did it. We made it through another one. We will effort to have time integrity and be in here earlier and get out on time as well. But thanks for sticking with us. Come back next week and don't miss the 3-day.
All righty. Take care, everybody.
Have a good week.